When Tom Clancy wrote The Sum of All Fears, the scenario he had in mind was a nuclear war between the United States and the Soviet Union. But we investors face a different kind of battle almost on a daily basis, with us having to evaluate the portfolio consequences of conflicts happening all around the world. There's inflation, trade wars for the most petty reasons, elections that can give the stock market some achhe or bure din. There's spiraling oil prices, climate changes, natural disasters, supply chain disruptions, and a lot more. The point is, we have no control on any of this, and more importantly, not everything requires our attention. And therefore, in this video, I shall take you through a few such scenarios with data as we try and examine if and how these externalities impact our portfolio, what we can do about it, and who are the winners and losers. This video might seem a little broad, but I'm hopeful it'll give that little extra investor's edge that we all seek. So let's begin. Okay, so let's start with wars and conflicts, and understandably, this has a massive economic impact on the country that's actively participating in the war. Case in point is the stock market in Ukraine and Russia that fell by over 40% within a month of that war starting. But this doesn't mean only the participating economies are affected, and even countries which are somewhat dependent or attached also face the fury of these wars and conflicts. For instance, many countries rely on the Ukraine and Russia for essential food items like wheat, corn, seed oil, etc. Now, when the conflict started, wheat, of which these two countries are big exporters, well, this product went off the consumption table in many countries, especially Egypt, which is the world's #1 wheat importer, and also countries like Nigeria, where the price of bread doubled in many places. So when evaluating the impact of war on a particular country, one has to link the geography where the conflict is happening with one's own trade. Like in the case of India, while we don't have a wheat problem, we do import a lot of fuel, precious stones, fertilizers, equipment, etc. from Russia. And likewise, we export pharmaceutical products, vehicles, organic chemicals, and more, which would have faced some disruption. So understandably, there is always some sharp sell-off initially, but when we look at the big picture, the markets often recover, and they recover quite quickly as the table shows. In fact, it's interesting to note when the tide starts turning, and in many cases, the stock markets start moving upwards when either the situation has started stabilizing or if the scope of the conflict becomes a lot clearer. For example, while most global indices were down 20% in the first 70-80 days of the Ukraine conflict, these indices started recovering as things became clearer in the battleground, diplomacy, and economic front. So generally speaking, wars, especially if your country is not an active participant, which is the case with India, then wars don't seem to have a major long-term impact on the stock markets. But yes, there is a short-term shock, and these dips can provide a decent opportunity to buy some index funds or ETFs. And while gold and bonds are always an option, within equities and within sectors, give a higher preference to some of the real-world industries like energy, metal, oil and gas, capital goods, construction, and the defense industry. Likewise, on a thematic basis and in the short run, styles like deeply undervalued stocks, price to book ratio, and dividend yielding stocks seem to do a lot better as compared to earnings dependent or growth stocks. So feel free to take advantage of some of these tactical opportunities, but generally there is no real reason to panic, at least for the long-term investor. The price of oil is another prominent external event, and for decades this has been as much a political metric as it has been an economic one. Now, the price of oil for many decades almost never crossed the $30 mark, but in the last 2 decades, $60 has become the new support line. In fact, at the time of recording this video, with the conflict ongoing in Palestine, there is every chance of a barrel of oil crossing the $100 mark if this thing spreads across the Middle East. For a country like India, which imports more than 85% of its domestic crude oil requirement, and specifically for Indian investors, understanding the correlation between oil and equities is an important one, as an increase in prices not only impacts the country's trade deficit and inflation, but also corporate profitability and therefore the stock prices. To this effect, I found an article on Business Line where the author studied 25 years of data And a correlation analysis found that in the short term, so let's say a month, when the price of crude moves sharply in either direction, then the Nifty 50 has almost moved in the opposite direction in many instances. On the other hand, over a longer period, so maybe a few months, it's generally seen that there are some additional influences. So it's not crude oil specific, and therefore the stock markets tend to go in the same direction as the oil prices. On a sectoral basis, a rise in crude oil prices negatively affects companies dealing in aviation due to the rise in ATF prices, paints which requires over 300 inputs and most of them are petroleum based, obviously the petrochemical industry, the tire sector wherein crude oil comprises nearly 60% of the product cost, and also cement, plastics and select FMCG companies that use crude and its derivatives as inputs. Another consequence of rising crude oil prices is an increase in the country's CAD, its current account deficit, which leads to a depreciation in currency which may not help a number of companies. But if you are invested in export-oriented sectors like IT and pharma, then a rise in oil prices is actually a positive in this case. The elections in India is one event that is closely monitored by investors as its outcome can have a significant effect on the market dynamics. I distinctly remember the 17th of May 2004, the first bloodbath I ever witnessed when the Sensex fell by 15.5% on that single day, and this was largely on account of a rather unexpected defeat of the NDA. Now, time and again, it has been noticed that in the lead up to general elections, the stock market typically experiences increased volatility. We saw this in the month prior to the elections in 2004, 2009, 2014, and probably 2019 was an exception because the incumbent government was largely expected to win that year. So as an investor, you may want to be a little curious, have a wait and watch approach, and what one really needs to watch out for are the state election results. And if there is uncertainty there, then the markets are likely to be volatile, with most institutional investors preferring to invest only in large cap stocks, at least in the short term. In fact, here's something interesting I found on the 2024 elections, and this comes from Morgan Stanley, who's made a sort of a decision tree for us that says, if the current government wins the election with a clear majority, then the market could gain between 0 and 5% in the 3 months after the election result. Scenario 2 is if the current government doesn't receive a clear majority and a coalition is formed, the market may fall between 5 and 25%. And if the NDA government loses and gets less than 200 seats, then the stock market could crash by a massive 40%, which is their worst case scenario. So this is a game of probability, and depending on what you feel, who you listen to, how the state elections and opinion polls come about, a simulation, a structure can be drawn around this data which can help an investor decide his or her next moves. But that being said, over the long run, so the next 3 to 5 years after the election, the market has consistently delivered over 12% returns, and personally there is nothing much to say that this won't be the case regardless of whoever wins the 2024 elections in India. Okay, next up is the silent assassin, inflation, and these words by Milton Friedman explains how impactful this can be. Now, we normally equate inflation as a negative trigger for equity markets, and for good reason, because high inflation means a high cost of living, which in turn translates to lower purchasing power, and as a consequence, it affects the profitability of companies. Additionally, inflation can and it definitely influences RBI's monetary policy decisions, which can impact interest rates and therefore the overall market sentiments. Now, ironically, equities actually benefit from higher inflation in the medium to long run. Yes, I'll say that again, inflation is good for equities in the long run. And while this might seem counterintuitive at first, when I think of it a layer deep, then it's something that's rooted in several economic and financial principles. For instance, in an inflationary environment, companies may experience higher revenues and profits for the simple reason that they can now pass on the increased cost to their consumers in the form of higher prices. As a result, corporate earnings tend to grow, at least in nominal terms, even if the real inflation-adjusted earnings don't grow as fast, and that pushes up the stock price. Similarly, a second direct advantage is in terms of asset prices, and inflation can visibly drive up the value of assets, including real estate and stocks. So moderate inflation has its advantages, and when we look at India's growth over the last many years, you'll notice that the GDP has never grown substantially when the inflation was low, and that's exactly the problem that has besieged Japan for so many decades now. My point is, inflation within limits is actually good for the economy and is also good for the stock markets over the medium to long term. And the next time you're tempted to calculate the inflation adjusted real return for a stock or your portfolio, then feel free to use this formula on your screen to get a realistic assessment of how you're doing with your investment. The fifth fallout I want to discuss is the currency exchange rate. And if you haven't planned your holidays for the winter, then look at Turkey or Turkey, as in the Turkish lira, which was 10 Indian rupees just a couple of years back, is now available for just 3 rupees. So in this case, the Indian rupee is getting stronger to the Turkish lira. And if the same thing were to happen with a prime currency like the US dollar, that is, the rupee becomes stronger, then that's something foreign portfolio investors would love, as it gives them higher returns from their Indian investments, which will trigger even more investments into the Indian stock markets. Now, the local currency becoming stronger is not what generally happens in India or most emerging markets. And while global investors do factor in a degree of currency loss, however, if the rupee depreciates heavily or there are signs that this might happen, then it can lead to foreign investors pulling out of the Indian equities, which will result in a stock market decline. This has been more of a non-event so far, and while the Indian rupee has depreciated by 14% in the last 5 years, the Nifty has risen by 93%, giving these foreign investors a decent CAGR of 11%. On a sectoral basis, export-oriented companies in the IT, textile, and pharmaceutical space, which earn the bulk of their revenue in US dollars, do stand to gain from a depreciating rupee. On the contrary, depreciation is likely to hurt companies that import stuff, so companies in the oil and gas, FMCG, automobile sector, etc., and perhaps also companies like Page Industries and Jubilant Foodworks that have to pay royalties to foreign companies in dollars for their franchisees in India. Right, so this video was a commentary on some external variables that we don't really control and how these factors can affect our portfolio and its performance. In addition to wars and conflict, price of oil, elections in India, inflation, and the currency exchange rate, there are a few more factors like climate change, trade wars, natural disasters, regulatory changes, etc., which can have a profound impact on our investing and investment returns. I would request you to read up more about these from time to time, and now that I've mentioned reading, I'm seriously thinking of starting a newsletter. It's an idea that is still ripening, but what I'm thinking is maybe 2 or 3 posts in a month to start off with, and the idea is to go deeper into a topic which can include strategies, sectors, even stocks, including microcaps, turnarounds, contrarian plays, and even some new research that has come up. I don't have the structure completely laid out and I haven't written my first post yet, but because it's still going to be nice to get some subscribers under the belt, I'll appreciate if you can subscribe to it using the link in the description of this video, and we'll take it one step at a time. Once again, thank you for your time and support. Do like this video, do tell your friends about my channel, and I'll see you 3 days from now. Until then.